Net Wealth Investments Limited is licensed to provide general advice. Our podcasts are not tailored to any one financial situation and may contain views of our presenters which may not align with Net Wealth's. The guests' organisation and Net Wealth have an arrangement for their financial products to be available for investment through the Net Wealth platforms, and Net Wealth may receive fees from the guest. More information about Net Wealth can be found on our website, including our financial services guide and disclosure documents. Please seek professional advice before acting.
Welcome to the Net Wealth Portfolio Construction Podcast, brought to you by the Net Wealth Investment Research Team. In this podcast series, we pick the brains of key wealth management professionals to uncover opportunities and challenges for investors on a diverse range of topics. We hope you enjoy their unique perspectives.
Welcome to the Net Wealth Portfolio Construction Podcast series. My name is Paul O'Connor and I'm the Head of Investment Management and Research. Today, Tim Gerrard from Janus Henderson Investors joins us, who is a portfolio manager based in Sydney. Good morning, Tim, and welcome to the Net Wealth Portfolio Construction Podcast.
Hi, Paul, and thanks for the opportunity to talk to you guys.
Nice to have you with us this morning. Janus Henderson Investors is a global asset manager offering a full suite of actively managed equities, fixed income alternatives and multi-asset strategies. Established through the merger of Janus Capital and Henderson Global Investors in 2017, their history as independent investment managers stretches back to 1934. The group employ more than 340 investment professionals based in 25 regional locations and managed around $480 billion of assets as at 31 of March 2022. Janus Henderson investment management teams operate autonomously, with the parent company providing shared non-investment management functions such as compliance, human resources, sales and marketing. The Global Natural Resources team consists of 5 investment professionals and as at 31 March 2022 managed approximately $1 billion. Tim Gerrard joined Janus Henderson in 2015 when 90 West Asset Management was acquired. Prior to 90 West, Tim worked for Lonsec Securities, conducting sell-side research targeted to the institutional market, and has previously been in similar roles at Investec Securities and Ausstock Securities. Before Ausstock, Tim held a number of stockbroking positions and he started his career as a project approvals accountant with BP Oil Exploration, before becoming a trainee mining engineer with Hammersley Iron in Western Australia. Tim received a Bachelor of Commerce and Bachelor of Mineral Technology degrees from the University of Otago and later studied auditing, tax, trusts and estate planning at Victoria University of Wellington. He also holds the Quarry Manager's Certificate from the Department of Mines, Western Australia. Tim has 42 years of financial resources experience, so is certainly a very experienced and qualified person to be joining us today to discuss the resource sector. The Janus Henderson Global Natural Resources Fund is a specialist global resources strategy and is a long-only, actively managed, bottom-up, conviction-based portfolio of global resource companies across the mining, energy and agricultural subsectors in both developed and emerging markets. The fund aims to provide a diversified exposure across segments of the natural resources chain, including upstream, being production and exploration, midstream, being storage, transportation and marketing of commodities, and downstream, being smelting, refining and selling of processed mining, energy and agricultural products to end users. There are 7 Janus Henderson funds available on the Net Wealth Super and IDPS investment menus, covering global equities, multi-strategy and Australian fixed interest, and including the Janus Henderson Global Natural Resources Fund that Tim works on. The global resource sector has been subject to a lot of focus and share price volatility in recent years, due in part to issues such as the growth of ESG, increasing long-term commitment to renewable resources, and of course Russia's invasion of Ukraine earlier this year. The sector is so diverse when you consider it encompasses hard commodities, energy and soft commodities, but is so fundamental and important to society given we all use commodities on a daily basis. Energy has been such a strong performer this year, mainly due to a refocus on energy security, courtesy of Europe's reliance on Russian energy. So I'll certainly be interested in Tim's views on the opportunities and the threats facing the various resource subsectors. With the recent rise in geopolitical risk, inflation and interest rates in developed countries this year, I'm also interested to understand what impact this has on resource companies' earnings, given a large amount of resource usage is independent of the economic cycle. And of course, given Australia is one of the largest producers of hard commodities, such as iron ore, the performance of the resource sector has a direct impact on the performance of the Australian economy. Tim, I note you spent the early part of your career working with BP and Hammersley Iron, so can you explain how you ended up in financial services as a portfolio manager of the Global Natural Resources Fund, and what benefits do you believe actually working hands-on in the resource sector provides you today as a portfolio manager?
Thanks, Paul, for that very fulsome introduction. How did I end up to be a fund manager? The story is a slightly meandering one, and there's many strands to it. But I think the start of where I've ended up is actually at a high school. It's like a boys' own boarding school. It's in Oamaru in New Zealand, just north of Dunedin. It's called Waitaki Boys. We did a lot of schoolwork at the school, obviously. Paul, there was a lot else besides schoolwork going on at that school. And the school was a little bit ye old empire. It was kind of boys, lots of boys who'd been killed in the First World War and the Second World War. There was a huge hall of memories and memorial to those boys killed, something like 300 of them. And somehow all of that got translated into a weird thing that we did as part of our being boarders. We started to dig tunnels. We dug tunnels from one dormitory to the next. We had stolen cans of pineapple down there. We used to hang out in these tunnels that were quite deep and quite long. And somehow that's got me interested in geology. We had a geology teacher at the high school, and he got me interested in geology. And those sort of two things combined, suddenly I was at Otago University doing geology, then mining engineering. And then before I knew it, I was in Cobar, 2 kilometres underground, helping the miners recover copper. Now, that was pretty scary for a 19-year-old, but that's where it started.
Were the tunnels you were digging at school? Did the teachers understand what you were doing, or was this all at the impetus of the students and the boarders?
Yeah, this was just a boarders weird thing. I mean, the first couple of years after school, we'd be play tennis or golf, but by the end, we're digging tunnels. And no, if the masters knew, we'd be heavily caned.
I wonder if the tunnels are still there today, or if they've been filled in there, Tim.
They could have been filled in. But Paul, the other interesting thing, without dwelling on this too much, but school is very important, obviously, for everyone, or certainly was for me. And my last year at school, it wasn't so much about exams. It was about reading and doing the extra. And that's when I read about Silent Spring, a book by Rachel Carson. And she was really one of the first environmentalists that brought to everyone's attention the harm that chemical pesticides were doing. And I think when you combine that sort of love of geology with this extra reading I was doing and my rural background, and all of that came together when I had a year off. Just to expand a little bit more, Paul, I went from Dunedin to Edinburgh overland in 1975. And this kind of links back to my interest in sustainability right now. You know, you saw the environmental degradation through Asia, you saw the plastic pollution, you saw the urbanization and the growth, all in context of where I'd come from, New Zealand and Australia. And when I'd put my mining engineering degree together with the BCom, went into mining, went into stock picking, stockbroking and fund management. And here I am now with a good organization that's seeped in ESG. Janus Henderson has an excellent team in London, but we know the importance of resources, but equally important is the recovery of those resources in a sustainable way. And this is how our portfolio, Global Natural Resources portfolio comes together.
So it sounds to me like you were born to be a global resource portfolio manager there, Tim.
I think that's true. I love what I do. I can't believe how lucky I am to be doing what I'm doing.
When many people think about resources, they think about mining or drilling for coal, oil, gas, that type of thing. But as I understand it, you have a different view, Tim. So can you please talk or explain to the listeners what this view is?
This is our view, it's my view, and it's our team's view, is that think of resources as something we just can't do without resources. And think of resources as a modern enabler to the world, humankind being able to be warm, eat well, have shelter, have communication. And when you think of it this way and you take a step back and you say, look, we've got to have copper, we've got to have lithium, we've got to have aluminium. All those things are absolutely critical for the renewables as we decarbonize with increased solar, as we decarbonize with wind and with electric vehicles. And then that's almost like the metals component of what we look at. But then there's the energy component. It might have all been oil and gas. Now it's sort of transitioning to more gas and more LNG, liquefied natural gas. Even nuclear is back on the headlines again with good reasons. So we have, when we think of energy, Paul, we don't think of the old fossil, just the fossil fuel. We think of the new energy, the LNG, the renewables, and battery storage and hydrogen. And then, just to round it out, our view of resources, it's got to include agriculture, natural resources like forestry, recycling of paper, recycling of metals, sustainable agriculture. Alternative protein is making inroads into meat and dairy. And so you've got a multitude. When you think resources, think of a basket of modern day enablers to a cleaner and healthier society.
Well, as I mentioned in my opening, I think we all consume resources on a daily basis, and they are fundamental to our life that we live and improving the standards of living as well. So I certainly understood there, Tim. ESG themes like climate change and natural resources seem to be an unlikely pairing, but I understand you now manage a strategy aimed at net zero emissions by investing in resources. So how does that work? And I guess a general view is that it is more about advancements in green technologies that helps the planet to decarbonise rather than through natural resources.
Yes, I mean, you're dead right. When we decarbonize, as the world decarbonizes, it's going to electrify. That involves solar, involves wind and electric vehicles. And if we wanted a pure portfolio, we could say to you, here's a low carbon portfolio, a zero carbon portfolio of all the good stuff, and let's forget everything else. That, of course, is not practical. It's unrealistic. We don't have solar or wind or EV unless we have copper. And I'll use copper as an example. Good conductivity, doesn't corrode, can be recycled. And because of this move to renewables, Paul, it looks like there's another 4 million tonnes a year of copper required by 2030 just to meet the new demand from renewables and EVs. An electric vehicle has 4 times the amount of copper involved than does an internal combustion engine. So when we look at our new strategy, it's called a J0. It's a transition to net zero. It's an ETF. It's active. And so we want to fill that portfolio up with opportunities that help the world decarbonize. As I said, we can't decarbonize without copper, without steel to build the turbines, or without aluminium to make lightweight vehicles.
With all that in mind, and given the diverse range of natural resource subsectors, how do you think about portfolio construction? And I note you also allocate to emerging markets. So how do you also think about the additional risk associated with allocating to emerging markets in the context of overall portfolio construction?
When we look at our global natural resources portfolio, we have a broad benchmark there. So it's S&P Global Natural Resources, a third metals and mining, a third energy, and a third agriculture. So that, if you like, is the starting template of a portfolio construction. And I guess all else equal, we could have a third, but we try to use our expertise to pick the right third at the right time. At the moment, we're a little overweight mining and we're a little underweight agriculture. But the best way to think about the portfolio construction, it is active, it's bottom up, and it comes back to the same old important process. Is management as good as what they should be? Are the costs low of the companies that we're investing in? Are they low-cost providers? Do they have a long mine life? Is their debt moderate to low? Is there a good growth profile like in a copper company? And are there some near-term catalysts? It could be a change in the way in which ESG ratings are perceived. So we build the portfolio up from the bottom up, taking into account ESG and those things I've just talked about, and then aware of where the final weighting might be, and we might balance that weighting. Now, with regard to the emerging markets, we do invest in emerging markets, but I'd say at the moment that's less than 10%. That is a little bit like a firecracker. We'll have a little bit exposed to emerging markets because it might give us an extra bang for the buck, and that could be exploration companies in Ecuador or Argentina, or a fantastic copper company in the DRC called Ivanhoe Mining. But I'd say emerging markets, Paul, is a minor part of our strategy. Some 55 or 60% of the portfolio is in North America, 20% in Australia. And I think this is important because we are in a volatile sector. 65% of our global natural resource portfolio is in companies with a market cap of greater than $10 billion. We want to be at the big end of town, big liquid companies in a volatile sector where we can control the risk.
Before we bring you the second part of this chat, a little bit about who we are. Netwealth is an ASX-listed company established to help Australians take control of their financial futures. With a wide range of super and investment accounts, a huge variety of investment options and market-leading online tools, we can help you manage your wealth your way. Partner with us to see wealth differently and discover a brighter future. Visit the Netwealth website to learn more and get the PDS, which you should read before making a decision. Products issued by Netwealth Investments Limited.
Perhaps you could give our audience some examples of what we might think of as traditional resource companies and the positive steps they're taking towards ESG. And I guess this question's also in light of increasing, public negativity and perception towards even the likes of the BHPs and Rios of the world.
I think you mentioned Rio, and I think the public perception about Rio, it's just spot on. It's just very, very disappointing. While I was in stockbroking, that was my favorite company for many, many years. It was ahead of the pack in terms of ESG for at least 15 years. It was a perceived leader. And then, interestingly, it steadily lost its way through the mid-2000s as it concentrated on cash flow, dividends only to shareholders. It became the company's mantra that shareholders were really all that it was about. And then in 2020, they destroyed the Juukan Caves in the Pilbara, and that was the end of one generation of management in a way. So Rio's a good example of a company that went from top of the pack to middle of the pack, and it's now trying to fight its way back. A better example is BHP. In my view, BHP is an ESG leader. You've seen an example recently of how they've rejigged their portfolio. They've spun out into Woodside, their oil and gas assets. And it's a massive move, $15 billion worth of oil and gas assets and the selling of some thermal coal. That portfolio has been restructured with a view to BHP being a new company and taking advantage of new opportunities, primarily around decarbonisation for the next 30 or 40 years. They are going to drive their strategy around decarbonisation, whether it's copper or nickel, or to some extent potash. And when you look at copper, they are ready to expand in copper either through existing operations or you'll see more M&A or bolt-on acquisitions. And so there, Paul, at the macro level, they're positioning for the new world. The new world is decarbonisation. And on the more direct ESG, they've got very strong leadership for the last two CEOs. They have a concept which I'm all in favour of. A lot of companies talk about social license. You need the social license. You need to demonstrate the goodwill and get the community on side to be permitted to build a mine. But often that is a very transactional thing. And once the mine is built, the social license can drift off and it's just a little bit of motherhood. BHP's view is social value. They want the community, the stakeholders, they want them to embrace BHP and for BHP to be embraced within society and the community. And to do that, it's got to be fully transparent, good stuff, bad stuff, what its plans are, how it can help the community, etc. Executives, their remuneration is tied to this. The power of the mine manager to make decisions in direct conjunction with the community rather than go back to London and get permission to do something. So BHP's got its portfolio positioning right and it's got its attitude right where it wants to be embedded in society in a positive way over the long term. I think it's capable of doing that.
Yeah, well, I think there's no doubt that there's strong evidence that companies that are managed ongoing to the standards of society are the more accepted companies and successful companies over the long term. So very interesting to hear your comments about BHP and the social license and embracing the community and trying to be positively giving to the community, I guess, on an ongoing basis there. Many resources, such as iron ore, are often viewed as more cyclical investments. Is that still a fair comment today in light of where we're at?
Yes and no. The answer really, Paul, is that commodities are cyclical. Soft commodities like, wheat and soybeans depend on the weather. The supply depends on lots of things out of the control of the grower. Likewise with mining, the supply can be hit by tragedies or weather. Demand can be higher or lower than expected. So all commodities are basically pretty volatile. And iron ore is a good example of the volatility, but most are volatile. And Paul, when I look back in the early 90s, China was producing 90 million tons of steel, and so was Japan. China now produces 1 billion tons of steel, and each ton of steel needs 1.5 tons of iron ore. So that massive change to the equation from China created an iron ore price going from $20 to $200 a ton. Then we had the GFC, it was back to $30 a ton. And then recently it went up to 200 again, and now it's back to below 100. But you can almost come up with similar order of magnitude figures if you're looking at oil, for instance. So a lot of volatility. Iron ore is a good example of volatility right now. All I can say is we need to manage that portfolio. That's why we have our 3 buckets of mining, energy, and agriculture. That's why we go for low-cost companies with long lives, and we spread the risk and we have low debt because the portfolio is designed to manage the volatility.
We've heard a lot more about global supply chains and geopolitical events recently, and I mentioned Russia's invasion of Ukraine in my opening and that impact on energy and, I guess, energy supply, particularly across Europe. So to what extent are they impacting on the potential for natural resources?
Natural resources is such a broad gamut. I can give you some examples, but in the European Union, it's all about how to substitute for Russian gas. If anything, they're doing that a little bit quicker than what we might have thought possible. But that might mean building more LNG import terminals. It might mean ramping up thermal-powered coal stations that had been put on care and maintenance. So more coal, more LNG. Nuclear is making a comeback for good reason. So that's got big impact for the demand for uranium oxide, which is a product that we like a lot. There's one direct change, a bit of a swing to uranium again. In America, The Americans their steel industry would import pig iron, high-grade steel products or iron products from the Ukraine and Russia. They've had to find alternatives for that, and that's including maybe importing high-grade iron ore from Canada. You've got the whole issue about security of supply. Countries like America are coming up with a list of critical minerals. They're going to increase their own domestic mine production. They'll do that with a company called Freeport-McMoRan. They'll open new copper and lithium mines in America. There's opportunities for Linus and rare earths. So we're seeing this nationalization, bringing things back home, onshoring to help even out this sort of supply chain disruption that both COVID and the Russian invasion has caused.
Equity markets have witnessed a broad sell-off on the back of rising interest rates, and clearly inflation is back and is an issue we're going to have to deal with, and even potentially the prospect of a US and Australian recession. How do you look to recession-proof your portfolio?
I wish I had the perfect answer for that, Paul. I really do. The recession-proofing, some of it comes back. In fact, a lot of it comes back to us sticking to our process. I'm sorry to labor this point, but the process has to involve companies that are low cost, low debt, good ESG, good management. The mix of those companies insulate us from the unknowns of a recession. And remember, it's a two-edged sword. There is no guarantee. We could recession-proof the portfolio until the cows come home, and there might only be a 30% chance that there is a recession. So we have to be very careful about going one way or the other to too much of an extreme. So that means sticking to the process is important, and it means understanding the bigger picture, like is China's stimulus going to happen or not? And is it going to be positive for resources? There's an opportunity and a risk there. What is going to be the speed of increased demand on commodities because of the renewables, because of the drive to renewables? We've got to be alert to those. And the good news about commodities just at the moment, normally and often if we were going into a recession, the resource sector is way overblown with too much inventory because everyone's been expanding, and it's way overblown with debt. What gives us a lot of comfort, Paul, right now is that the LME stocks, the stocks of commodities like copper, year on year, they're down 35%. Nickel stocks in the LME down 70, aluminium down 80. So the stocks of commodities available are low, and the companies we follow have low debt. So that, in a way, means that we're quite well positioned in case there is a recession. We're not going to go back to the GFC, where Rio Tinto had to have a massive capital injection to avoid going broke.
It certainly makes sense to have in your portfolio to have an exposure to resources, as we understand the importance of resources are to society, but it's a long-term play as well. So certainly not a short-term investment there, but it certainly makes sense that every portfolio with an equity exposure should have a significant exposure as a long-term aim in the portfolio. With all that we've discussed today, such as decarbonisation and net zero initiatives, even recycling, what does the future look like for resources? So can Tim Gerrard look into his crystal ball and give us some comments on new growth areas for the sector?
I can look into a somewhat cloudy ball and sort of see something emerging. I'm very, very positive. And the positivity, it comes really from the world has to be a cleaner, better place, more sustainable. One of the ways it's going to do that is through decarbonisation, copper, lithium, aluminium, new technologies. They're all there in our sector. So very, very positive. Recycling, there's going to be changes and policies all around the world to get you to make sure you recycle your aluminium can, your cardboard box is going to be made easier to do that. And the products made from that recycled production is going to be far lower in carbon emissions. That's a big opportunity in resources. Forestry, in order to absorb this extra carbon, there's something about over the next 50 years, the world needs to plant about half the size of Australia in trees. So good forestry companies that can find the land to do that and do that properly. Hydrogen, very excited about hydrogen. That's made possible now because renewable energy is cheaper than it's ever been, and that means that hydrogen can be made greenly. And then lastly, we've got EVs, electric vehicles. Penetration globally is ahead of expectations. So my view is, sure, crystal ball's always a bit dangerous and it's hard to get the timing dead right, but the future for our broad basket of resources, I would say it's never looked better, and the state of the companies that we can invest in has never looked better. By the way, Paul, final one, if we want to add new copper supply, it's very restricted. It takes 10 to 15 years to get a new copper mine permitted. It could be that the copper upside is just going to be massive because of this new demand.
No, interesting. I didn't quite appreciate the demand and the ongoing demand for copper, but certainly with the move to EV and the demand for copper in building those vehicles, it certainly makes sense. I can't let you leave the podcast without asking about your outlook on the Australian resources sector. And I guess I know you made some comments about the way BHP have been changing in the way their operations work and function and interact with society. I guess there is a view that we are a specialist in old resources. So we've been a beneficiary for over 2 decades now on China's growth, as you articulated earlier, and their demand for iron ore because of the steel production in China and their demand for our hard commodities ultimately. But what does the future look like for Australian resources? And do we have any areas that are sort of leading in ESG or clean energy, or are they all more offshore examples of companies that you can think of?
The resource sector for Australia is very innovative. You know, over the years, it's invented a lot of strong technologies and copper flotation, all sorts of things. So it's innovative. We've seen the innovation in the startup sector. We've seen the innovation flow through into agriculture, into sensing, maybe carbon soil sequestration. There's a lot of innovation in Australia. And specifically with respect to resources, I hear your comment about old, but I would prefer to say things are in transition. Iron ore might be old, but steel is the driver of construction all around the world. And steel can be made to be a new commodity, if you like, by making sure it's got a low carbon footprint. And so if you're an iron ore miner in the Pilbara, Fortescue, BHP, Rio, all got initiatives on how to get more involved in renewable energy and work out ways to produce iron ore scope 1 or 2 with lower carbon emissions, and then work out ways with their customers how to get that lower with new technology and reduce scope 3. So iron ore creates steel. All of that's long-term project. In the meantime, we can get good returns from recycling of steel. But to come back directly to your question, I would think of Australia has had 2 decades of massive Chinese growth. Let's hope that the Chinese growth can at least stabilize and moderate rather than fall. So if there's a stability to China, then our big new opportunity comes down to new demand from renewables. And that new demand from renewables is going to help the best iron ore mines, it's going to help the best coking coal mines and copper. Rio Tinto is looking at ways to get renewable electricity to run its aluminium and alumina operations in Queensland. So I would come back and say the next generation of resource growth in Australia is all about decarbonisation. It's all about renewables. That will go into hydrogen, and we will be a better place from all of that helping support our existing resource industry, which also gets added new demand from copper, lithium, and aluminium. So Australia, well placed.
It's been a really fascinating discussion with you on your thoughts and views on the sector. And I guess as you've been talking through it, it's just been on my mind that what a huge diverse subsectors of resources exist. I feel like we've only just scratched the surface. There's so many areas of what we've discussed this morning. So I think we'll have to get you back on next year for another, maybe a deeper dive into clean energy or something of that nature there, Tim. Also fascinated to find out more about those tunnels that you dug back in your school days there. So I do thank you very much for joining us this morning on the podcast, and certainly wish you all the best there, Tim.
Okay, thanks for the opportunity.
To the listeners, thank you very much for joining us again. I hope you've enjoyed today's discussion with Tim Gerrard from Janus Henderson, and I look forward to you joining us on the next instalment of the NetWealth Portfolio Construction Podcast.
Thanks for listening to this episode of the NetWealth Portfolio Construction Podcast Series. For more episodes and to subscribe to our series, visit our website www.netwealth.com.au or visit the iTunes Store or Spotify. We hope you can tune into our next episode.